Hello, today's January 10th, 2022. Happy New Year. And it's time for a new stock picks video. This time last year, in addition to my usual 3 stock picks, I gave general investment recommendations for the whole year. And I'll do the same. I'll do the same this time around. We had a pretty good market for equities and real estate last year, and inflation has been running a lot hotter than the central banks would like it, or the people would like it too. And this year we are likely faced with an environment of reduced quantitative easing or no quantitative easing by the central banks, and possibly a rising rate environment. And with valuations in stocks being so high, a rising interest rate environment is not particularly good, especially for the high multiple stocks like the super high growth stocks, which tend to be mostly tech stocks. Rising interest rate environment hurts bonds, hurts stocks, hurts real estate. It's kind of hard to hide, and it definitely increases volatility. So it's going to be a tough year to predict what happens to the markets. Well, every year is tough to predict, but this one may be even tougher. And we may end up with a little bit of a roller coaster drive and end up at the same place that we started. Could be a little bit higher, it could be lower. But in such an environment, especially when we still have very low rates and higher inflation, a good asset class to allocate money to is farmland. Not something that you traditionally find in retail investors' portfolios. Is usually the ultra high net worth family offices and some institutions that own farmland. But we have a way of investing in Canadian farmland here for Canadian residents for our clients, and we would definitely be adding to farmland this year. The asset class is not correlated with equities or real estate, not correlated with interest rates, other than when there is a highly negative real rate environment, meaning the nominal rates are much higher than the actual inflation, which is not likely to happen for the next few years, if ever. So we feel good about that. Plus, it's very stable. So that's one area to add money to. Another area that has been in focus for the last 5 years or more, actually maybe 10, 15, but has been more popular in the last few years, is climate change. And it's hard to take advantage of that directly. Usually people play it through electric car manufacturers like Tesla and so on, but those are super high growth stocks that tend to not do very well in a rising interest rate environment. So there is a new way of participating in that through carbon credit futures, and there is an ETF that was launched just over a year ago, and we adding, well, for the first time ever, into the carbon credit asset class, if you can see it as an asset class. It's like a commodity, a part of the commodity as asset class, I suppose. That's an area that we're adding to. Other areas to add to, traditional kind of absolute return type areas like private debt in an environment where it's likely to be higher volatility and maybe a lower return this year. A class that has very little volatility and a decent return in the 7-8% range also makes a lot of sense. And now it's time to move to some stock picks, and let's first review the picks from this time last year. I recommended Alloris Financial, symbol ALRS, which was up 2.2% since this time last year. Haverty Furniture, HVT, up about 5.9%, including dividends, since this time last year. And DR Horton, DHI, which was up 41.2% for an average of 16.4%, which compares with 18.4% for the MSCI World in US dollars, including dividends. For this year and this month and this year really, 3 new stock picks, which should fit well with the current scenario, like rising rates, increased volatility, and compression of multiples for stocks. First one is Manulife, a Canadian insurer, trading at a very, very reasonable valuation, has a very decent yield, and insurance companies tend to do well when rates rise because they can invest new premiums from insurance policies into high yielding bonds when rates go up. And Manulife is a strong company with a strong balance sheet and very reasonable valuation, having completely underperformed the market in the last 5 years. Perhaps it's time for it to catch up, which should provide for a better return than the market and a decent return regardless going forward. Next one is also a financial services company. This one is a bank in the US. In the US, banks do well when rates rise, unlike perhaps Canadian banks that hold a lot of their loans on their balance sheets and borrow on the short end of the curve and lend out at like 5 and 10 year terms, and do really well when there is a upward sloping yield curve. In the US, banks tend to originate loans and then sell them off, and they tend to do well in a rising interest rate environment. And one such bank that could do well over the next 12 months is Service First Bankshares, symbol SFBS. They do commercial, consumer, other loans, accept deposits, banking, electronic banking services, all the traditional things that banks do. Third pick. This is a company called Fabrinet. They are engaged in providing outsourced manufacturing services to OEMs that need complex manufacturing capabilities. This is primarily technology hardware type products. We are staying away from adding to the super high multiple tech stocks, but this is not such a super high multiple stock. It's more reasonably valued and in the hardware business rather than in the more intangible aspects of technology. So we believe this is going to behave more like an industrial company rather than a tech company. So has a chance of continuing to do well, the stock anyway. And that will be our third pick for this month and for this year. Again, if you would like a second opinion to see whether these stocks fit in your portfolio or if it's already well diversified or not, please give us a call. Thank you.